I want to jump right in today because the data we're looking at is just, it's honestly staggering. We have this new whistleblower leak, and
it's 1.2 seconds.
Right, 1.2 seconds.
That is the exact amount of time a human medical director and some of these massive health insurers is spending on average on a single patient file.
Wow.
They're spending 1.2 seconds reviewing a claim for denying it.
Which is, I mean, that's basically just a rubber stamp.
Exactly. It is a rubber stamp for an algorithm. The AI decides to deny your medical care, and the human doctor just clicks approve. And the internal data shows they're doing this with a 90% plus approval rate.
And the crazy part is when you get that denial letter in the mail, you know, as a consumer, it's not just a little note saying, hey, we won't pay for this.
Oh, no.
It's this hyper complex, like 15-page wall of legal text.
Generated by an AI.
Right, generated by an AI citing all these obscure medical precedents and algorithmic risk scores and dense policy clauses. And so because of that administrative friction, 85% of consumers who get these letters just give up.
They just surrender.
Yeah, they surrender. They pay out of pocket because they assume fighting this massive technical document is just mathematically impossible.
And that is entirely intentional.
Yeah.
It's a mathematical optimization.
Yeah.
It's literally designed to exploit human fatigue.
Unbelievable. Well, welcome to MediaGenX. Today, we're doing a deep dive into this 90-minute masterclass essay. It's titled The AI Insurance Cartel: How Algorithms Are Pricing Your Life and Bankrupting the Middle Class.
It's a heavy one.
It really is. So, okay, let's unpack this. Because if you're paying any attention to your own balance sheet right now, you know, your household budget, you've probably noticed that your auto and home and health premiums have just skyrocketed over the last 24 months.
Oh, yeah. Everybody is feeling it.
And if you call customer service, they give you these lines, right? Like, oh, it's supply chain bottlenecks, or it's extreme weather, or it's just general inflation.
Yeah.
But the reality that this research details is that those are just analog excuses. And they're masking this massive digital transition. The whole underlying architecture of how risk is calculated is being completely rewritten.
Yeah, we are transitioning away from human estimation. We're moving from shared social burdens into this era of just absolute algorithmic certainty.
Right.
I mean, the insurance industry is undergoing a structural overhaul right now that is honestly on par with when the stock market moved from physical trading floors to high-frequency algorithmic trading. It's that big.
It's massive, and we're going to map out exactly how your vehicle and your property and even your biological data are being surveilled and priced in real time. But I want to plant a flag right now on where this is ultimately heading, because the essay talks about algorithmic redlining.
Yes.
We're looking at the birth of what they call the uninsurable class.
Which is terrifying.
It is. It's a future where bad luck is basically replaced by mathematical destiny.
Right.
Where your individual digital footprint just dictates whether you can even participate in the modern economy. But to really grasp how this AI transition works, we kind of need a very quick grounding in the baseline model, right? Like the model it's destroying.
Right. So to understand the sheer scale of the disruption here, you have to look back. I mean, since the days of Lloyd's Coffee House, like 300 years ago when they were underwriting shipping routes, the whole industry has relied on this deeply social concept. It's called pooled risk.
Okay.
Because humans couldn't perfectly predict the future, right? So they grouped risks into these massive, blunt demographic buckets.
Like the classic dinner bill analogy.
Exactly.
Like 30 people go out to dinner. Most people just order a side salad and tap water.
Right.
But like 3 people order Wagyu steak and top shelf liquor. And then at the end of the night, everyone just splits the bill evenly.
Yes.
So the people who ordered water are effectively subsidizing the heavy spenders, which is, you know, it's highly inefficient for the salad eaters. But as a macroeconomic safety net, it meant nobody faced financial ruin at the end of the meal.
Precisely. And that structural inefficiency is called adverse selection.
Right.
And it was incredibly lucrative for legacy insurers.
Right, yeah.
Because they made billions by overcharging the safe customers in the pool to cover the risky ones.
Yeah.
And they relied on these lagging proxies, you know, age, gender, your zip code.
Yeah.
But today, in 2026, we have hit what the source text calls the actuarial singularity.
Okay, wait, I want to stop you there and push back on the framing of the singularity as a negative thing.
Okay.
Because if I'm the guy eating the salad in that dinner scenario, destroying the pool actually sounds like a massive win for me.
Sure.
Like, if artificial intelligence can completely eliminate that informational asymmetry and calculate my exact individualized real-time probability of disaster down to the decimal, I mean, isn't that just a perfectly efficient market?
Wow.
Like, if I'm a perfect driver, I should pay a tiny premium. Why is isolating risk perfectly a bad thing?
So if we connect this to the bigger picture, perfect pricing actually destroys the mechanism that allows insurance to function as a societal safety net. When you isolate risk with decimal point precision, the pool evaporates entirely. So yeah, if you are mathematically perfect, your premium approaches zero.
Right.
But if the algorithm detects a high-risk variable, like maybe a structural vulnerability in your home's geography or a genetic marker in your health profile,
Oh, wow.
your premium doesn't just bump up by 10%, it spikes to a level commensurate with certain disasters.
Jeez.
The AI removes the subsidy. It essentially transitions insurance from this community defense mechanism into just an individualized subscription to your own statistical doom.
That is such a dark way to phrase it. An individualized subscription to your own statistical doom.
It's true, though.
So the product ceases to be insurance and just becomes basically prepaying for your own inevitable crisis.
Exactly.
Okay, let's look at the actual mechanics of how they're gathering the data to isolate that risk. Let's start with our vehicles. The essay refers to this infrastructure as the telematics panopticon, which is quite a term. And a few years ago, I remember the contrarian take was that those OBD2 diagnostic dongles you plug into your car, or those safe driver smartphone apps,
Oh, yeah.
people thought those were great progressive tools to save a few bucks.
Right, and that popular narrative was just incredibly successful marketing.
Really?
The industry positioned these things as discount tools, but in reality, they are continuous surveillance engines.
Wow.
They are designed to feed high-frequency telemetry into gradient-boosted machine learning models.
Okay.
So they are moving away from the motor vehicle record, the MVR,
Sure.
because an MVR is a lagging indicator. It only updates if a human police officer actually issues you a citation or if a crash report is filed.
Right.
Which means it misses over 99% of your actual kinetic behavior on the road.
Yeah, that makes sense. And the granularity of what these machine learning models are actively weighting is really what caught my attention in the text.
Oh, it's wild.
Because we aren't just talking about a binary check of like, did you exceed the speed limit?
No.
The AI is ingesting raw sensor data to calculate the exact G-force when you navigate a highway on-ramp.
Yep.
It measures micro-hesitations in your braking patterns to establish a baseline of your reaction time.
It does. And it also runs spatial temporal cross-referencing.
What does that mean exactly?
So if your daily commute requires you to drive at 2 a.m., or maybe you're always in the 5 p.m. gridlock, the model automatically weights your profile with a high-risk cognitive fatigue multiplier.
Are you serious?
Absolutely. And it maps your GPS coordinates against hyperlocal collision databases. So it's calculating the statistical danger of literally every intersection you pass through on your way to work.
Okay, wait, how does a model process that much real-time telemetry from millions of drivers without just hallucinating a risk profile?
Yeah.
I'm struggling to see how they separate signal from noise. Like if I brake hard because a child runs into the street, I'm a good driver, right?
Yeah.
I'm paying attention.
Right.
But if I brake hard because I'm texting and I just didn't see a stop sign, I'm a bad driver. But the G-force of the stop is exactly the same. So how does it know?
So here's the thing. The AI does not care about context. It only cares about correlation. These gradient-boosted models don't need to know why you decelerated rapidly. They only need to know that drivers with high frequencies of rapid deceleration have a statistically higher cost of claims over a 10-year horizon.
Wow. So it just lumps you in.
Exactly.
Yeah.
And the processing actually happens partly on the edge, like inside your smartphone or the vehicle's onboard computer, which compresses that telemetry into packet data.
Okay.
And then that data is fired via API to the insurer's cloud. And it's recalculating your risk weights dynamically.
It's like having a permanent invisible driving instructor just sitting in the passenger seat, and he finds your BICS account every time you tap the brakes too hard.
That is exactly what it is. And there is no human underwriter to appeal to anymore. You can't just call your agent and try to leverage your 10-year loyalty history with the company. If your telematics score drops by even a fraction of a percent, the AI automatically reprices your premium at the millisecond your policy renews.
That is brutal.
It predicts not just the probability of a crash, but the exact dollar severity based on the physics of your daily route.
Man.
But the physical surveillance doesn't stop in the driveway. The source material outlines how this transitions directly into property and casualty, so homeowners insurance.
Right.
We are seeing the rise of what they call the satellite underwriter.
Yeah, which marks the absolute death of the human inspector.
Oh yeah, they're gone.
Because historically, someone with a clipboard would walk your property, look at the roof, and pull a CLUE report, the Comprehensive Loss Underwriting Exchange, just to see if the previous owner had water damage or whatever.
Right. The manual inspection is entirely obsolete now.
Yeah.
Because the AI cartel is now utilizing high-resolution, multispectral satellite imagery and low-altitude LiDAR drone sweeps. And this isn't just a basic photograph of your roof like on Google Earth.
Right.
Multispectral imaging measures different wavelengths of light, so it allows the AI to literally detect the moisture content in your wood framing.
You're kidding.
From space?
From space or from a drone. And it can see the thermal signature of an aging HVAC compressor.
Unbelievable. And I want to break down that specific mechanism a bit more because it's wild. The AI uses computer vision to measure the exact topographical grading of the soil around your foundation.
Yes.
And then it cross-references that with LiDAR elevation maps, which are supposedly accurate down to the centimeter, all to calculate the precise fluid dynamics of how water will flow across your property during a flash flood.
Yes. And what's really fascinating here is the automation of the penalty.
Right.
The text provides this brilliant case study of this computer vision in action. So an insurer's AI scans your suburban backyard from orbit, and it compares the imagery to a baseline from 6 months prior.
Okay.
And it detects a new geometric anomaly, a blue circle.
Blue circle. Yeah. And it classifies this as a newly installed swimming pool. Or maybe a trampoline.
Which are basically the ultimate actuarial liabilities.
Exactly. They hate pools and trampolines.
Yeah.
So the algorithm immediately flags this new hazard, and it automatically executes a premium hike on your policy.
Just like that.
Your rate increases before you even think to notify your agent that you bought a pool.
And the physical data is being aggressively married to our digital footprints, too.
Yeah.
The text details how insurers are actually purchasing loyalty card and credit card transaction histories from third-party data brokers.
Yes, they are.
So the AI creates algorithmic proxies for risk based on your consumer behavior. Like if the data shows you purchased a high-end DIY chainsaw at a hardware store, your liability risk multiplier bumps up.
Yep.
Because obviously playing with chainsaw is risky. And if your transaction history shows a high frequency of late-night fast food orders,
the model interprets that as an indicator of fatigue, poor metabolic health, and chaotic lifestyle management. And they hash your identity. So they connect your credit card swipe to your home address and your telematics profile. And they weave all these disparate digital breadcrumbs into this cohesive predictive risk matrix.
Which naturally brings us to the most intimate application of this technology, which is the biological underwriter.
Yes.
Because when the AI models penetrate health and life insurance, the extraction becomes deeply personal. The source text highlights a human story here that illustrates exactly how insidious this is.
It's a sad one.
It really is. So a perfectly healthy patient applies for a standard life insurance policy. No history of cardiac issues, no cancer, nothing. Yet the automated quote comes back at double the standard premium.
Yeah, and the justification for that was buried in a throwaway clinical note from half a decade earlier.
5 years ago.
5 years ago.
Yeah.
Because the AI utilizes natural language processing, NLP models, and it parses unstructured electronic health records pulled via API. So 5 years prior, during just a routine checkup, the physician typed a casual observation into an iPad. It just said, patient appears fatigued, reports high stress at work.
And that's it.
That's it.
See, I would assume NLP just flags keywords.
Huh.
But how does an AI distinguish between a doctor casually using the word stress in a conversation versus an actual clinical diagnosis of like a severe anxiety disorder?
The modern NLP models don't just look for isolated keywords anymore. They map semantic relationships and they contextualize the surrounding text against vast medical databases.
Okay.
So to a human, fatigued and stressed is just conversational context. But to the AI, it is structured data.
Wow.
It maps those words to specific ICD-10 mortality vectors, and it cross-references it with minor data points like your age and your occupation, and it calculates an elevated probability of an early cardiac event.
Man, here's where it gets really interesting though, because my immediate reaction to reading that was to question the legality of it all. Like, we have regulatory frameworks like the Affordable Care Act that explicitly prevent insurers from penalizing consumers for pre-existing conditions. So how are they circumventing federal law?
They do it through this gray area called algorithmic inference and through the deployment of corporate wellness programs.
Ah, yes, the subsidized smartwatch trap.
Exactly.
Where your HR department offers you a free wearable device as a perk, and they promise you these minor health premium discounts if you just hit your daily step goals.
Right. And the research frames these wellness programs as Trojan horses for biological underwriting.
Interesting.
Because the insurer isn't technically denying your baseline health coverage based on a formal doctor-diagnosed pre-existing condition,
Right.
which would trigger a regulatory violation.
Right, they can't do that.
Exactly. Instead, the AI ingests your continuous biometric exhaust.
Gross term, but okay.
Yeah, it's looking at your heart rate variability, your sleep architecture, your estimated VO2 max.
So the algorithm basically infers a state of metabolic decay, like pre-diabetes or hypertension. And it does this without a doctor ever actually writing a prescription or a diagnosis.
Precisely. It creates a biological proxy. And they take that inferred risk and they use it to dynamically price ancillary unregulated products.
Oh, I see.
So they drastically increase the premiums on your supplemental life insurance or your short-term disability riders or critical illness coverage, things that aren't protected the same way.
Wow. Because in the past, securing a significant life insurance policy meant you had to do a physical paramedical exam. You gave blood, you provided a urine sample, and you waited weeks for lab results.
Right.
But today, these accelerated underwriting models just bypass the fluid tests entirely. They ping your prescription drug history databases and your biometric telemetry to price your mortality in milliseconds.
Yeah, your biological degradation is quantified and monetized in real time.
So what does this all mean for the back end of the business? Because extracting maximum premiums through this perfect pricing is only half of the equation. The other half is capital retention when a disaster actually occurs. Let's look at the deployment of the LLM claims denial engine.
Yeah, so the central metric dictating the valuation of any insurance company is the loss ratio.
Okay.
The business model is brutally simple. Maximize premium collection, minimize claim payouts. Protecting the loss ratio is paramount.
Obviously.
And historically, the primary friction point in protecting that ratio was human empathy.
Human empathy.
Yeah, because a human claims adjuster had to review your medical file, interpret the policy, and draft a justification for denial. And humans are slow. And occasionally they approve borderline claims just out of compassion.
Right. But that empathy bottleneck has been structurally eliminated.
Completely.
The major carriers have integrated generative AI, large language models trained specifically on the corpus of historical insurance law, decades of claim denials, and those dense 80-page exclusion clauses buried in your specific contract.
Yes. And these models operate as what the essay calls a generative loophole.
Explain that.
Well, they aren't just writing emails or generating code. They're architecting highly complex, legally dense walls of text engineered to starve the policyholder of their payout through a semantic trap.
Let's walk through the mechanics of that trap because it's devious. Say a doctor submits a prior authorization for an MRI to evaluate back pain.
Yep.
The AI intercepts the request, and in milliseconds, it scans millions of lines of policy text looking for an exclusion. If the doctor's clinical note uses the word chronic instead of the word acute,
The AI weaponizes that specific semantic distinction.
wow.
It categorizes chronic as a pre-existing degenerative condition, which is explicitly excluded under some buried subclause of the policy. And then it autonomously generates that 15-page denial letter citing obscure medical precedents.
Wait, let me stop you there, though. Isn't weaponizing a minor semantic difference a massive legal liability?
Yeah.
Like, if an AI starts denying necessary MRIs based on one word, doesn't that open the carrier up to catastrophic bad faith lawsuits from state regulators?
This raises an important question about how these models are actually tuned.
Okay.
Because the AI optimizes for a metric called denial yield.
Denial yield.
Yes, the algorithm calculates the absolute maximum percentage of claims it can reject without crossing the statistical threshold that triggers a regulatory audit or a class action lawsuit.
You have got to be kidding me.
It mathematically budgets for the tiny fraction of consumers who will actually go out and hire a lawyer. The entire system relies on administrative friction. The AI knows that 85% of consumers lack the time, capital, and energy to fight a supercomputer over an MRI bill.
So they basically weaponize the complexity of the contract to force capitulation.
Oh, exactly.
It's brilliant in its cruelty. So if the middle class is being squeezed by these hyper-dynamic premiums on the front end and LLM denial engines on the back end, we have to fulfill our MediaGenX mandate here. We have to follow the money.
Always.
Where is the capital actually flowing in this transition?
Well, every massive technological shift mints a new generation of monopolies.
Right.
And in the actuarial singularity, the primary beneficiaries are not necessarily the legacy insurance brands you see on television commercials. The real wealth transfer is happening at the infrastructure level.
Yeah, the essay points to a specific real-world case study here, naming the actual monopolies of this era, and it's the risk data brokers.
Yes.
Companies like LexisNexis Risk Solutions, Verisk, and Cambridge Mobile Telematics.
These data brokers are essentially the picks and shovels of the algorithmic gold rush.
Okay.
An AI underwriter is entirely dependent on the quality and volume of the data it consumes. And these brokers own the underlying plumbing.
Right.
They aggregate the sensor data, the multispectral satellite imagery, the prescription histories, and the credit telemetry. They format it, structure it, and sell it to every insurance carrier on Earth via high-speed APIs.
They have essentially built API toll booths.
Yes.
Every single time a carrier's AI queries a profile to price a policy or adjust a risk weight, these data brokers extract a microtoll.
Every single time.
And they hold zero actual insurance risk on their own balance sheets. They literally just tax the mathematical infrastructure of the entire industry.
Which sets up the first major investment vector outlined in the masterclass. And that is shorting the legacy insurers.
Right.
Because the traditional property and casualty and auto carriers are sitting on a massive unpriced liability due to the adverse selection death spiral.
Walk us through the mechanics of that macro trade. Why would I short a legacy carrier when they have these huge balance sheets?
Because AI native, highly capitalized new entrants are using these API toll booths to perfectly identify the statistically safest drivers and homeowners.
Okay.
And they siphon off the perfect customers by offering them marginally better rates.
Which leaves the legacy insurers who are still relying on those slower, outdated demographic pools we talked about.
Right.
It leaves them holding toxic pools of the riskiest customers that the AI native firms explicitly rejected.
Exactly. And to cover the mounting losses from that toxic pool, the legacy carrier is forced to raise rates across the board. And that rate hike drives away whatever good customers they have left, which accelerates the collapse of the pool.
A literal death spiral.
It is. And when you combine that death spiral with unpriced climate risk and social inflation, which is the rising frequency of massive jury awards in liability lawsuits,
Right.
shorting technologically stagnant mid-tier legacy carriers presents a highly asymmetric trade.
But there is another crucial element to this wealth playbook, because obviously the ultra-wealthy are certainly not paying $20,000 dynamic premiums to retail insurers just to have their claims denied by an LLM.
No, they aren't.
The research details a really fascinating structure for how high net worth individuals escape the AI cartel entirely. The 831B microcaptive.
The microcaptive is a tax-advantaged corporate entity recognized by the IRS.
Okay.
It allows a business owner or a family office to create their own fully licensed insurance company for the sole purpose of underwriting their own risks.
Hold on. So instead of a business owner paying a massive premium to a commercial carrier like State Farm or whoever, they pay that premium directly to an entity they control.
Yes.
How exactly do the lawyers structure this to remain compliant with the IRS? I imagine the scrutiny is pretty intense.
Oh, the scrutiny is incredibly intense, which is why it requires specialized actuaries and captive management firms to run it.
Right.
It was originally designed for small businesses to ensure obscure risks that standard carriers wouldn't touch. But the wealthy utilize it to self-insure standard risks.
Okay.
So the business pays the premium into the microcaptive, which lowers their taxable operating income.
Oh, nice.
And if there are no claims filed that year, the capital doesn't just vanish into a commercial carrier's profit margin. It remains inside the captive trust, growing tax deferred. And it can eventually be distributed back to the owners as a qualified dividend.
Wow. But what if there is a catastrophic claim? Say a massive fire destroys a commercial property they own.
Well, the microcaptive pays the claim out of its reserves. And for catastrophic losses that exceed the captive's limits, they purchase wholesale reinsurance on the institutional market for pennies on the dollar.
Oh, I see.
But the real leverage here is the claims process itself. When you file a claim with your own microcaptive, you are the claims adjuster.
Wow.
There is no generative AI denial engine searching for semantic loopholes. You approve your own claim.
So the wealthy just bypass the friction entirely.
Completely.
But obviously, setting up an IRS-compliant offshore or domestic captive requires significant capital and legal infrastructure. It's not an option for the average listener who is just trying to insure a Honda Civic and a suburban home.
No, it's not.
Which brings us to the playbook. What specific steps can the everyday consumer take this week to protect themselves from this algorithmic extraction?
The primary directive is establishing insurability hygiene.
Insurability hygiene.
Yes. You must begin treating your behavioral and biometric exhaust with the same paranoia you apply to your social security number or your credit score. So the first step is to actively opt out of all tracking applications.
Meaning, do not install the Safe Driver app. Do not plug in the OBD2 dongle.
Correct. Unless you can guarantee absolute mathematical perfection in your physical behavior, the surveillance will inevitably be weaponized against you.
Wow.
The nominal upfront discount they offer is a trap. It is not worth the catastrophic permanent premium hike when the model decides your late-night braking patterns indicate cognitive decline.
Good point. Okay, so step 2 involves the physical hardware in your environment. Pay cash for your Internet of Things devices.
Yes. We discussed the telematics panopticon earlier. If you purchase a smart thermostat or a water leak detector or a home security system, do not link the hardware to your primary digital identity or your main credit card.
Okay.
You want to sever the data pipeline between the physical sensors in your home and the centralized risk profile the data brokers are compiling on you.
And step 3 is a tactical defense for when a disaster actually occurs. When you have property damage or a complex medical claim, you cannot rely on the carrier's AI-friendly preferred vendors.
Absolutely not. The moment you file a claim, you are entering a hostile negotiation with an LLM.
Right.
You must hire an independent public adjuster or a professional medical billing advocate. Their specific expertise is translating your analog tragedy into the precise structured data format required to bypass the AI's automated denial triggers.
So you can't just write a heartfelt letter to an adjuster anymore. You literally have to beat the algorithm syntactically.
You have to fight the machine with an advocate who speaks its native language.
Man, as we enter the final segment of our analysis here, I want to look at the macro perspective, the 5-year outlook. When the actuarial singularity is fully realized across all asset classes and biological models, where does this leave us?
This raises an important question about the fundamental contract of civilization, honestly. Because when you perfectly price risk, you destroy the concept of luck. And without shared luck, you destroy the social safety net. We are hurtling toward the reality of algorithmic redlining.
The uninsurable class.
Precisely. The AI doesn't view you as unlucky. It views you as statistically destined for failure.
Wow.
If climate models dictate that your specific zip code is mathematically guaranteed to experience severe flood events over the next decade, the carrier doesn't simply increase your premium. They price you out of the market entirely.
Like a $20,000 annual homeowner's premium.
Yes.
And without affordable insurance, the bank will not issue a mortgage. If you cannot secure a mortgage, the value of the underlying real estate completely collapses.
Exactly.
You are locked out of wealth generation entirely just because a satellite and a predictive model decided your topography was toxic.
And we will see this mirror exactly in the biological models too. If your biometric telemetry suggests microtremors associated with early onset neurological decay, the life insurance algorithm quietly declines your application, citing unquantifiable actuarial risk.
So the 5-year outlook is essentially a society violently stratified by insurability.
It is.
The ultra-wealthy insulate themselves within micro-captives and concierge out-of-pocket healthcare. And the middle class is trapped in the panopticon, bled dry by dynamic premiums that extract their disposable income just to maintain baseline coverage.
And the vulnerable class, the geographically and biologically unfortunate, they are locked out of the private risk market entirely, and they get pushed onto an underfunded, collapsing state welfare system.
Man.
The ultimate safety net just becomes a mathematical sieve.
So what does this all mean? Today we examine the collapse of pooled risk and the rise of algorithmic certainty. We unpack the mechanics of the telematics panopticon, detailing how gradient-boosted models and multispectral satellites basically underwrite our physical reality.
Yeah.
We analyze the LLM claims denial engine designed to maximize denial yield through semantic traps. And we followed the capital to the data broker API pull booths and the micro-captives shielding the wealthy.
It really is a complete rewiring of our economic reality. The algorithms are constantly observing, and they are repricing your life in real time.
To close out today's deep dive, the source material poses a final provocative hypothetical, and it gets to the very core of this technological trade-off, and we want you to consider this for your own household.
Right. If an artificial intelligence guaranteed you a flat 50% discount on all of your insurance premiums today, like instantly cutting your major costs in half.
Okay.
But in exchange, it required unrestricted 24/7 API access to your vehicle's telemetry, your home's environmental sensors, and your real-time biometric data. Would you take the deal?
How much of your privacy is your financial survival actually worth? It is a trade-off millions of consumers will be forced to navigate in the very near future. We invite you to mull that over.
The choice is arriving much faster than the market anticipates.
Thank you for joining us for this deep dive into the actuarial singularity. As always, remember that all our analysis on MediaGenX is strictly educational commentary. It is not financial, legal, or investment advice. Do your own research, protect your capital, and guard your data. We will see you next time.